I'm Dan Isard. This is the third short video introducing members of the IFDF for the new and unique association-sponsored program, iSuccession. In this video, I want to demonstrate how the business and the business real estate fits into the computation as part of the iSuccession process. In the last video, I introduced you to the computation of estimating how much money you may need to be financially independent. Let me start this lesson from that point. The estimate revolves around the assumptions you want to make. Everyone gets to make their own assumptions. The assumptions are current age, retirement age, expected lifetime, standard of living, the expected average inflation rate, and the expected return on your investments. So let me create a hypothetical example. Assume that you're 55 years old and you had planned on being financially independent at age 65. Assume you want enough money to be financially independent for your lifetime, which you expect will end at 90 years old. You want this lifetime income to provide you with the buying power of $100,000 a year. You're assuming an inflation rate of 3% and an average return on your investment of 4%. When we input this information into the computer, it tells us that you're going to have a need to have assets of $4 million. Approximately. This will come from assets that you have under your control and those that you have a right to receive the benefit that is outside of your control. For most people, this non-controlled asset is Social Security. If I look at a hypothetical balance sheet for this hypothetical person, I would see the following assets under their control. Obviously, we don't know the value of the business or business real estate just yet, but this puts us in a position of having approximately $1.2 million before we arrive at that computation. The Social Security benefit over the course of your retirement life is going to be valued at about $1 million. Now that'll change for every person depending upon how much you've paid in, what your maximum salary was, and whether it's for you or yourself and a spouse. Therefore, in this hypothetical example, we have a need for $4 million, and we've identified assets under your control and benefits you'll be able to receive of about $2.2 million. Of these assets under your control, the largest we still don't know the value of yet. The largest assets are your business and business real estate. To solve that question, the solution is a valuation of your business and business real estate. This valuation needs to be done by a qualified and experienced appraiser. The business valuation should be done by a company that has experience with valuing funeral homes. While qualified appraisers may reach different conclusions, their experience will lead them to understanding what is the probable sale price of your business, regardless of who you sell it to. A company that has never valued a funeral business is offering a theoretical expression of value based upon a textbook they read. This analysis is too important a matter to deal with an uninformed guess. If we go back to our hypothetical example and plug in a hypothetical value for the business and business real estate, you now see that we've achieved a point of accumulating about $3.9 million, plus or minus, of assets under your control. Adding to that the $1 million value of Social Security benefit, we now have almost $4.9 million of assets to meet a need of $4 million. At first blush, it looks like we have enough assets to be financially independent. But we haven't taken 5 things into consideration. First, we have to take ordinary income tax into consideration. In order to use the proceeds of an IRA or a company retirement account, we have to liquidate that account, and in doing so, we pay an ordinary income tax. Ordinary income tax in today's world is about 35%. Second, we haven't taken capital gains taxes into consideration. Upon selling the business or the business real estate, we have to pay a capital gains tax. That's computed by the sale price in excess of your basis or what you paid for it. Now, basis is a very complex subject and too long for this video, but our computation will take this tax of about 23% into consideration. For the sake of this hypothetical example, I'm going to assume that the IFDF member has no basis. This tax is 23% of the gain as of today. Third, Social Security benefits may be subject to income tax. Depending upon your other income, it's possible that 50% of the benefit may be subject to ordinary income tax. So after taking taxes out, we don't have $4.9 million anymore. We now have about $3.9 million. While we're close to our need, there are 2 other matters that we haven't taken into consideration yet. The fourth consideration is a conceptual matter, not a tax matter. Most people assume their home equity into their financial independence equation. The problem is, you have to live somewhere. If you take the money out of your home equity, you need to pay it back. It's a loan. It has interest. And therefore, in order to make that payment, you probably have to increase your financial independence need. If you sell your house, you have to live somewhere. Maybe you're going to rent a home. But again, that's going to increase your financial independence need. So if you take these 4 items that were overlooked a moment ago into consideration, you'd now have about $3,464,000, which is more than $500,000 off, or a 13% error in your calculation. You can try to correct this mistake. First, you could lower your standard of living by 13% a year. Second, you can postpone your retirement date by 5 years. Third, get a higher return on investment. In other words, instead of getting 4%, try to get 4.5%. You could build more assets during the time period that you're still working, that 10-year period between now when you're planning and when you're anticipating wanting to be financially independent. Or lastly, rather than living 30 years after retirement, you could only live 25. I know that's not your favorite option, but as a good consultant, I need to point it out. There's another item that has not been calculated into this, and that is the fact that we're computing the assets as they're valued today, which in this case is 10 years before the date of financial independence. Making good investments and operating the business wisely will allow you to have more assets than needed, hopefully 10 years from now. In that case, maybe you can retire earlier. iSuccession is about giving you more time in your life to enjoy your life. The more you know, the sooner you know it, the more options you have. In future videos, I'll continue to lay out the benefits and solutions provided by iSuccession. In the meantime, if you have any questions, please send me an email or call.